Okay, welcome to Module 5. So now that you know about financial statements and how they've been prepared, etc., now we want to give you some tools to help you analyze the financial statements and figure out what they're actually telling you. So by the end of this module, you should be able to apply different types of analysis to the financial statements to evaluate the operating performance of a company and then identify benchmarks for financial and non-financial reporting. So in terms of the financial health, ratios are the number one way to evaluate the financial health of any organization, not just a cooperative. So some of these ratios that I'm using here are ratios that are used by every type of business that's operating. So the main four categories that you should be familiar with are liquidity ratios, for instance, what we call the current ratio. So we look at for liquidity, we look at your assets compared to your liabilities. So if your liabilities are greater than your assets, that's a problem. So it really reflects on your ability to pay your debt. And if your assets are less than the debt, then, there's going to be consequences. So for coverage, debt to equity, how heavily is the company dependent on debt versus equity? The activity turnover, for example, your inventory turnover, how long does it take you to turn that over? And profitability, looking at your profit margin, return on investment, etc. But in addition, of course, to these, quotes, regular ratios that are used by, all business enterprises, there's also certain industries who will have industry-specific ratios, such as the insurance and credit union. So basically, the financial institutions. So you should know how to calculate the ratios, but more importantly is what is the ratio telling you? For example, as I mentioned, the poor current ratio means that the cooperative doesn't have sufficient assets to meet its current liabilities. The other thing you want to do is look at trend analysis. So you want to compare the company to itself over a period of time of maybe, 3 to 5 years to show whether a company is improving its financial condition or whether it's deteriorating. So that's important as well. And when you're looking at these trends, you want to look at what's causing them. What are the external factors that cannot be easily controlled? For example, COVID-19. It happened. And compare that to internal factors that can be controlled. So maybe, there's a decline in memberships for a co-op supermarket. Well, maybe you want to do some marketing to get increased memberships, for example. So with benchmarking, in addition to actually calculating the ratios and comparing them over time, it's also really important to figure out how do you compare, how do you stack up against your peers in your sector. So different cooperatives and credit unions have different points of view about who they should compare to. So they agree they need to compare because, your 3 or 5 year trend analysis could show that you're actually making big improvements over time. But maybe even with those improvements, you're still well under the industry average. So from an accountability point of view, from a governance perspective, the board really needs to know not only how you're performing over time, but they also need to know, compared to the industry, how well are we performing. And I think that's excellent information because if you're performing much worse than your sector, why is that? You need to do some analysis to figure that out. Here, another concept is when you're looking at performance, some cooperatives say, we should be comparing to not just co-ops, but also to non-co-ops. So some credit unions say, well, we should compare to banks. But the downside of that argument is they don't have the same motivation with Banks, of course, the objective is profit maximization, whereas with credit unions, you have to make enough. You have to make enough to cover your expenses and to have, sufficient cash in reserves, but it's not all pure profit maximization. So there's an interesting article that I've included in here. It's called Enough, and it's by Ian Glassford, who's a retired VP of a credit union, and he makes a really good point about evaluating cooperative performance versus pure profit maximization. And it's also important really to compare, the cooperative health to other cooperatives as well. And then if you're looking at industry benchmarks, whether they be general industry or cooperative specific, in the lecture notes you'll see a list of various benchmarks, and some are publicly available, some are private, where a particular sector would pay to get the data. So for Living Lab number 5, this one requires you to use a cooperative other than your own. So what you're going to do is see how well you can use the tools, the ratios, etc., in the module to look at a set of financial statements that you're not familiar with to see if you can figure out what they're telling you. So here we want you to look at an industry standard or benchmark for at least 2 ratios from each of the 3 categories here, and then discuss what it's telling you about the cooperative that you're analyzing. So this concludes the video for Module 5.